Hello, hello, happy Thursday. Let me just make sure we're going live on all these right places quick. Go live now, go live. Perfect. Hi, everyone who's joining us today. We're so excited to see you here. My name is Maggie, and I'm here with Purse Strings as we do our Thursday Lunch and Learns. As you know, it is October, so we are talking about all things taxes, but we're making it a ton of fun. It's way more exciting than it sounds. And so today, at Purse Strings, we're all about providing this financial education, know-how, get some of those wheels turning. And then when you're ready to put things in transaction, we have top tier financial professionals who are willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Eric Blake is one of them. So we're excited to have him on today to talk about some super common tax myths that are out there. But before we dive into all the fun, Eric, I'd love if you could just give a real quick introduction to yourself.
Well, thank you, Maggie. Yes, my name is Eric Blake. I am the founder and lead financial planner with Blake Wealth Management. We're here in beautiful, historic downtown McKinney, Texas. I'm a certified financial planner. Just completed my 23rd year as a financial advisor back in July. As a firm, we provide tax-efficient retirement planning and investment management to both individuals and couples, a very high percentage of which are women, and many, of course, currently married, but also a very high percentage of our women clients that have at some point experienced divorce, loss of a spouse, or just may be single by choice. I chose to prioritize working with women very early in my career. Personally, I was raised by a single mother, never actually knew my biological father because they divorced before I was even a year old. And my grandmother, who was widowed at 62, and my grandfather, who I actually considered my father figure, passed away just over, it's almost 26 years ago now. And I know that women have made tremendous strides in the workforce, but many women also realize that on average, there's still a gender gap. And on average, women do have lower pension, Social Security benefits, lower retirement savings. But we believe very strongly that through better, smarter planning, women can often bridge at least part of that gap, if not the whole thing. And tax planning plays such a crucial role, not paying more in taxes than you need to. But there's also a tremendous amount of misperception when it comes to taxes. And that's what we hope to educate our audience today, is just dispelling some of these myths that many believe to be true. And so looking forward to the conversation and seeing how we can dispel some of these tax myths.
Awesome. Yeah, I'm excited that you were raised by so many great women. Can never have too many great women in your life. So before we dive in, we do want to just pop this disclaimer up in case you want to take it a nice read, just that this, is just for educational purposes only. So of course, always, consult a professional, and we got plenty of them for you to talk to.
Absolutely.
All right, now that we got all the fun out of the way, we are going to dive into these.
That was the best part.
Yeah, we're done now. No. So we're going to dive into some of these tax myths. And if anyone has any questions along the way, feel free to pop them in the chat. I'm also going to pop in the link of all these myths as well, so you can have them as a note. But let's just start from the top. So what's the first myth that you hear a lot, working with taxes?
Well, I think really you could say that the first two we'll talk about, you could spend the whole 30 minutes, an hour talking about just the first two. Because the first myth is that there's nothing I can do about my taxes. They are what they are. There's nothing I can do. But really, that's not the case. There are so many different things. As long as you're aware of them, there's so many different strategies that you can look at implementing. But you have to take the time to do that. You have to be willing to look at your tax return. You can't just stick it in the file or stick it in the drawer and just repeat that same process. So just knowing that there are things you can do is the place to start. So that's myth one, is that I can't do anything. The second one is there's nothing I should do, right? So that's one of those things that, you don't get any extra points for paying more in taxes than you need to. We kind of go with the philosophy that you should pay what you owe. We're not opposed to that, but don't give Uncle Sam a tip. So that's the other part, is that there's nothing I should do about my taxes. Just pay what they tell me to pay, and that's it. Again, if you take a proactive strategy, then that doesn't necessarily have to be the case.
Yeah, and I definitely have heard those and definitely believe them myself. Thinking that there's not much I can do to adjust it. But yeah, also pay your taxes. That's going to be beneficial in the long run. But yeah, why pay more than you have to? You'd
Pay your
rather have that.
taxes, but not, yeah, pay your taxes, but don't give them a tip.
Yeah, no need for that. I know a lot of places are asking for a tip. Uncle Sam doesn't need one. So what's the third one that you hear going around?
This is one that is out there, has been out there for probably as long as I've been a financial advisor, and probably much longer than that. But that getting a refund means that I've won the tax game, right?
Yeah.
That's a big one. People think that they treat it like a bonus. So if my tax bill was $10,000 and I got a $5,000 check back at the end of the year, so that means I paid in 15,000. Well, your tax due was still $10,000. You just let Uncle Sam sit on your $5,000 for 12 months
Great.
as an interest-free loan. And so that's actually not ideal. And so again, thinking that a refund is winning the game that's one of those myths that it just isn't true.
Yeah, I definitely it's always nice not having to pay out, rather that, getting some money back is always easier on the checkbook, of course. But yeah, people also, we did just release a podcast today as well, talking about a different kind of thing about the taxes. But yeah, that set amount is the same either way. You're going to have to pay that $10,000. So if you paid 15, you'll get some back. If you paid 5,000, you'll have to pay some more. So there's really no winning. That 10 grand is still what you owe. Right. Yeah, which is, feels like a win, but you're right. It's, you just loan them some money without interest.
Well, I mean, if you just using our example of if you got a $5,000 refund, that's about $400 a month you could have had throughout the year. That could be paying off debt. That could be increasing my retirement savings, putting money into a Roth IRA, whatever it is. That money is still yours. But would you rather have it throughout the year where you can actually make it work for you, or let Uncle Sam sit on it for you until they send you a check in April?
Which, if that does happen, that means maybe next year you want to take some different steps. So you could be using, let's say, that $400 towards these other items. If you're trying to pay off a credit card and you're getting a lot of interest there, you could just be paying that off instead.
And it could just be as simple as adjusting your withholding from your paycheck to say, hey, that gives me, maybe it's $200 per paycheck, $400 a month. Again, that can be used for your benefit rather than Uncle Sam.
Yes, definitely. So very common one. So then the next one I know is about CPAs. So what's the fourth myth out there?
It's that thinking that CPAs are all tax planning experts. And there's nothing against CPAs. Hopefully they don't take this the wrong way. But when you're thinking about tax returns, especially right now, CPAs are right in the middle of it. They're preparing taxes. But when they're preparing taxes, that's usually going to be based on what's already happened, not necessarily what could happen in the future. Or again, I keep referring back to taking a proactive approach of saying, hey, what could I do today to reduce my taxes for the rest of 2022? So when they're doing taxes right now, they're completing 2021. Mm-hmm. We still have 2.5 months left of 2022 where we can be proactive and take some steps to increase our 401k contributions or increase our Roth IRA contributions, whatever it might be. And so again, CPAs are great. I think a great CPA on your team makes a lot of sense. You need to have somebody on your side of the table when it comes to preparing taxes, but just know that a lot of times preparing taxes is in the past. We want to be proactive and look into the future and say, what could we be doing to reduce taxes in the future?
So it is, again, that team approach. So it's it's recommended, I guess, to work with your financial professional so you can do some of that pre-tax planning, and then maybe a CPA who does kind of that post work. Would you say?
I think that's exactly right. You actually would want my opinion as a financial planner, I want to be in communication with that CPA as well. You need everybody on the same page, because you don't want the financial advisor telling you one thing and you actually do something, and then the CPA doesn't find out about it until they're right in the middle of preparing your tax return and say, well, why did you do this $20,000 Roth conversion that I didn't know anything about? Or why did you do this or do that triggered more taxes? And they didn't know about it until they're right in the middle of trying to prepare your tax return. So being on the same page with all the professionals on your team is really crucial.
Yeah, everyone has to have the same goal and know what kind of the goal is at the end of the day. So it's not weird to connect your professionals and have them talk to each other. That's actually really good to have everyone on the same team and connect them. It's not like they're against each other, taking your business, but they're actually working jointly. So don't be afraid to connect your professionals together is, something I always just also want to pop in there.
Always, it's making sure the left hand knows what the right hand's doing, that kind of thing. Yeah.
Exactly. So number 5 is totally the myth that I'm going to take, saying that it's too early to worry about my retirement tax. I'm too young, doesn't matter to me.
Right. So yeah, and that's one of those things that tax planning, having control in the future when it comes to retirement starts today, as early as possible. So, we talk about how do you structure, maybe let's talk about maybe your investments. How do you structure your investments in a way that's going to give you tax efficiency in the future? So, so many people, every dollar they save towards retirement goes into their 401k because they're thinking today, it's saving me taxes today, but not thinking about, well, at some point when I take that money out, it's going to be taxable. Well, if every single retirement dollar you have saved for retirement is sitting in a pre-tax bucket and it's going to be taxable when you take it out, you have no control. You have no control over your tax situation. And Uncle Sam is going to dictate what your tax situation is going to be. Yeah. You have no control. But if I said, hey, maybe I need to put money into a Roth IRA, or maybe I need to, if I've got access to a Roth 401k, maybe I need to put some contributions in there as well to create some tax diversification. So many people talk about diversification. They think stocks, bonds, cash. That's diversification in most people's mind. In my opinion, tax diversification is, if not as important, it may be more important from a long-term planning perspective.
Yeah, I would say that typically later in life, people are in a higher tax bracket. So if you could pay some of that lower tax now, it would be money saving. But overall, it's interesting to think that not every dollar is, worth the same dollar now and later and all this other stuff. So it really gets more than, just 100 pennies in a dollar at the end of the day.
Absolutely. Yeah, I know. But it starts early. If you don't take action now, you don't have that future tax diversification.
Yep. So number 6 is probably my favorite myth on here, which is just my favorite. So I'll let you take this one away.
So tax laws are written by tax experts. That's the myth, right? That's not true. Tax laws are written by politicians. And we won't get into the whole political conversation here, but just knowing that there's always some motive behind why we have different tax laws that are put in place. I always think it's funny when you think about, if you go back and hear some of the names of these tax laws, how creative they are to make sure that their acronyms fit.
Yeah.
Somebody spends a lot of time coming up with those. I don't know who it is, but that's the thing you want to be aware of, is these are not tax experts coming up with these. Even as the example that's on, if somebody's taking a look at our 10 myths, the backdoor Roth conversion, backdoor Roth contributions, that was a mistake. They didn't really intend for that to be an option. So that's a perfect example of a strategy that we can utilize if we're proactive, that was never intended to act in that function.
Yeah, that's one of my favorites, because sometimes I know I'll look at taxes, I'm like, it just doesn't make sense. Well, yeah, that's because the tax experts didn't come up with it. Politicians did, or however. And, clearly they're the expert at their thing. They're not quite the expert at taxes. That's how you guys figured out how to do this, backdoor Roth or whatever it is. It's just, once you think about it, you're like, yeah, that makes sense. I hear all about politicians talking about taxes and what they're going to implement. But it's interesting how, it's not created by tax experts. So sometimes why doesn't always make sense.
No, that's all we can do is just take what we know, take the information that we've been given, and make the best decisions and figure out what strategies are going to make the most sense for us going forward.
Which I feel like is also all of you guys trying to keep up every year of what's new, what's changing, what's expiring, and all these other things as well.
That's for us tax nerds that actually like to read through this stuff, and it's part of our job. I mean, it should be. If you're, as a financial advisor, as a financial planner, you want somebody who's going to be looking at these types of strategies, these little nuts and bolts types things that you just don't have time. You don't have time to do that on your own. Now, some people do. There may be a handful of people out there that do, but you're doing what you do. You're working. You're spending time with your family, whatever you enjoy doing. But you want to have somebody that's out there on your side that is looking at these types of things.
And I'm so glad someone wants to. This is why I pay a professional, because you know the stuff, and I know, I stay in my lane, you stay in yours. All right. So what is myth number 7?
Myth number 7, tax laws are always changing, so there's no point planning for the future. It's all just a guess. Kind of ties to what we just talked about. It does change. We've got the tax laws that went into place in 2017 are going to go back after 2025. So 2026 is going to be back to what it was 10 years ago. So yes, all these different things are changing, but that doesn't give you the okay to just let it happen, right? So we still need to understand what these changes are, how are they going to impact you, and again, where we can create tax diversification. So if things do change in the future, you still want to have some level of control. And that's where being proactive really comes into place. Um, things are always going to change. You have to be prepared. You have to adjust.
I love that. Yeah, that's the world we live in. All right. So number 8.
Number 8, my employer doesn't offer a 401k, so I can't contribute to a qualified retirement account. Our country is made up of small businesses. Not every employer has a 401k plan, but that again doesn't give you permission not to plan for your future. So whether that's you go out and you set up your own traditional IRA and make contributions that way, if you are self-employed, you actually may have more options to save towards your retirement than employee life, where they're just going to have their 401k. So there's SEP IRAs, there's simple IRAs, there's solo 401ks. So there's all these different vehicles that are out there to help you save for your future, even if your employer, or even if that's you, if you're the employer. But if your employer doesn't have a 401k plan, there are still options you want to be aware of that can help you save towards the future.
And that's a huge one we talk about for stay-at-home moms, or, if you're a caretaker, because, your 401k is not being funded, by an employer, since you're not, having paid work, but you're still working hard. So you and your spouse can kind of work together and make that happen to make sure your 401k is funded as well. And that has some tax benefits too. I hear.
Well, it might be a spousal IRA. So yes, yeah. So if one spouse is working and one's not, depending on how much income you have, you might have the option of a spousal contribution, a spousal IRA contribution, spousal Roth IRA contribution. Again, depending on your situation, that could be a huge vehicle in order to, again, make sure that both spouses are able to save for their future.
Yep. So yeah, there's always an option out there. So make sure you're taking advantage of whatever you can. And so I know this 9th one kind of jumps back to something we were talking about before. But it's that I have a CPA, so I don't need a financial planner.
Yeah, and again, ties back as that says, see myth number 4.
Yeah.
Again, it's about what are CPA's role? There's some great CPAs out there. My mom is an enrolled agent; she does taxes as well, so I know what they deal with, what they go through, and how valuable they are to be part of your financial team. But again, a lot of what they're focused on is doing tax preparation, which is again looking in the past. There are some great ones out there that may be more into tax planning, but you want to understand that. And that's where, again, as a financial planner, that's where we spend a lot of our time, is doing these types of projections to say, hey, what can we proactively do to reduce your taxes in 2022 while we still have time? Or what can we be doing to reduce your taxes 5 years from now? I talk a lot about reducing your lifetime tax liability. And that takes, reducing your lifetime tax liability takes evaluation every single year. What actions can I take in 2022 that might be beneficial to me in 2032 or 2042? And so again, that's where, again, the idea of having a team, having a CPA that you feel confident in, that they're evaluating your tax situation, you're getting all the right deductions, you're not missing anything, but having somebody also who is looking into the future, looking at how I can reduce my lifetime tax liability. And again, ultimately, that they're all working together, that all your professionals are working together.
Yeah, I love it. I love it. And then we have number 10, last but not least.
$1 million in my IRA means I can withdraw $1 million when I retire. Again, we've kind of, as you see, all these myths all kind of tie together in some form or fashion. But that's where we're saying, okay, if I've got $1 million and I retire and it's in my IRA, keeping in mind that typically that's in a pre-tax bucket. So when it comes out, I'm going to have to pay taxes on those dollars. So $1 million might be really $750,000 to spend, or maybe less than that. So it really depends on the situation, but just knowing that if it's all in the pre-tax bucket, it's going to be taxable. So making sure, again, that we're planning it far enough in advance to say, hey, what are my income needs going to be when I do retire? And can I do anything to control my taxes? Can I look at proactively maybe taking smaller distributions earlier than waiting till I am retired, or waiting till required distributions? Those types of things. So again, it's all about proactivity.
Yep. As we know, Uncle Sam will always get his taxes either before or after. So there is no avoiding that. So yeah, it's not always just that $1 million is $1 million. He's gonna get his money sometime.
But again, and that's where starting today and understanding what should I be doing today. Should I be complementing my 401k contributions with Roth IRA contributions, or just a brokerage account, something not in the retirement world that might give me some flexibility to do some other things that don't have any ties specifically to retirement accounts.
Yeah. Well, I think we've busted a lot of great myths. It's really showed that you need to have your professionals working together. You can't solely rely on either one of them, but as a team, they really need to be together. And it's never too early to start planning. It's a great conversation to have today to plan for tomorrow, as well as 10, 15 years down the future as well.
Absolutely.
Are there any last tips, tricks, pieces of advice that you want to make sure you share with our audience today?
No, I think, again, it comes back to that idea of lifetime tax liability, not just current year tax liability or last year's tax liability. Again, so many people think, okay, I've got my tax return done. I stick in the file. We do the whole process over again the next April. And then every April after that, it's just a recurring process where I just don't want to look at it anymore. I don't want to look at my tax return. I don't want to do anything. So we say, hey, well, if you just take a few minutes, look at your tax return, pull some of the key numbers out of there. What was my total income? What was my adjusted gross income? My taxable income? What was my total tax due? Not that I get money back or not that I have to owe money. Just look at some of these key numbers and say, looking proactively, 2022, is there something I can do now to improve my tax situation this year, but also in the future? Can I make Roth IRA contributions? Should I increase my 401k contributions? What can I be doing to improve my tax situation? And again, dispelling some of these myths, or again, understanding that these are truly myths, which means they're not true. There are things you can do. As long as you are aware that they're not true, then you can take action on improving your tax situation.
I love it. And if anyone else really wants more tax information, you should check out our podcast where we also have Eric on there. Women and Money, the shit we don't talk about. It was just released today, so it has some different tax information than what you heard on here, but it's also great to get some more information. So I appreciate you coming on here, Eric, and giving us your expertise. If anyone has any more questions, feel free to reach out to Eric. His email is going through the bottom. He's also one of our Purse Strings approved professionals, so you can check him out on our site, pursestrings.co. And we will be back here again next week with some more fun tax information. So stick with us. And we're happy to answer any questions that you have because we are here to help you be financially fearless. So thank you, Eric, and we'll talk to everyone soon.
Thanks, Maggie.
Talk to you later. Bye.